अरे मौका बिना फिक्र के जीने का मिल गया। 12, 20 और 80 से इन्वेस्टमेंट करने का तरीका मिल गया। जो आने वाले कल की प्लानिंग करके चलते हैं, सोच समझ कर उनको इन्वेस्ट करने का सलीका मिल गया। 12, 20 और 80 से पीस ऑफ माइंड मिल गया। म्यूचुअल फंड में इन्वेस्टमेंट करने का तरीका मिल गया।
Finally balanced, active, passive, index or managed, तरीका मिल गया।
क्वांटम के म्यूचुअल फंड, क्वांटम के 12, 20 और 80 से इन्वेस्टमेंट करने का तरीका मिल गया।
क्वांटम म्यूचुअल फंड के 12, 20, 80 यानी 12, 20, 80 एसेट एलोकेशन अप्रोच ने इंडिया को सिखाया इन्वेस्ट करने का सही तरीका। और जानकारी के लिए सर्च करो क्वांटम 12, 20, 80 एसेट एलोकेशन। म्यूचुअल फंड निवेश बाजार जोखिम के अधीन है। योजना संबंधी सभी दस्तावेजों को सावधानी से पढ़ें।
Good evening, everyone, and warm welcome to the webinar on Budget 2023 and its impact on your investments. My name is Neeraj Kotian, and I'll be the moderator for today's panel discussion. I am part of the customer interaction team at Quantum Mutual Fund. Thank you all for taking our time on Friday evening and joining us for this session. We'll request everyone to use the headphones for the better audio clarity. In today's webinar, the presentation will be approximately 30 minutes. And then it will be followed by Q&A. You all can post your questions in the chat box once the presentation is over. As you all know that our Finance Minister, Nirmala Sitharaman, has already announced the Union Budget, which has set the mood for the next fiscal. We at Quantum believe that it is very important for you to understand every aspect of the budget to know its impact. Hence today, our speakers will share some key highlights of the budget and guide you strategically to make the right move for your mutual fund investment portfolio. Also, they will answer the questions like, is the budget geared to tackle economic uncertainties? What will be its impact on the asset classes like equity, debt, and gold? What does it mean for you and your mutual fund investments? Before I hand over the control to our speakers, let me quickly introduce them to you all. Our first speakers for today's evening is our Chief Investment Officer, Mr. Chirag Mehta, who has close to 2 decades of experience in managing commodities and specialized in the field of alternative investment strategies. He has been the fund manager of Quantum Gold Savings Fund, Quantum Equity Fund of Funds, Quantum Multi-Asset Fund of Funds, and Quantum India ESG Equity Fund. Our second speaker is Mr. Pankaj, who has over 11 years of experience in fixed income investments and research. He is a qualified CFA. He joined Quantum Asset Management Company in August 2013 and at present is the fund manager for Quantum Dynamic Bond Fund and Quantum Liquid Fund. And our third speaker for today's evening is Mr. George Thomas, who has close to 7 years of experience in equity research in multiple sectors. He has been part of Quantum since 2016 and at present is the fund manager for Quantum Long-Term Equity Value Fund and Quantum Tax Saving Fund. Without taking much time of yours, we'll request our speaker to take ahead this session.
Thank you, Neeraj, and thank you everyone for joining us today. Budget is being announced. Our overall take is positive on the budget. There could be more done. It's always the case. But we will take you through in terms of what the budget brings in, what were the disappointments really, what is the impact on investments overall, all 3 asset classes, equity, debt, and gold. So let us deep dive into what this budget brings for all of us. So if you look at the budget 2023, we think that it's a long road approach. So at one hand, we saw heavy investments announced, which is higher capital expenditure, which is needed indeed to ensure that the cyclical recovery continues. So what we were seeing, if you see the backdrop, first we had government do the heavy lifting, which led to the recovery in the economy and thereby increase in consumption. This was post-COVID period that government lifted or did the heavy lifting, which kind of led to the recovery in the economy, led to boosting in terms of consumption because incomes and employment was robust. And thereafter, because of the demand increasing, we saw private capex, private companies announcing more capital expenditure, and that led to a cyclical momentum in the economy. Again, housing boost, things like IT, hiring, etc., all helped along the way. But it was the government that did the heavy lifting initially. Even now, the government thinks that it needs to be in the driving seat, and therefore they think that it's going to be, they should be doing more capital expenditure to ensure that the recovery continues. So there were announcements like infrastructure, for example, railway with a 2.4 lakh crore expenditure budgeted, 15 new airports, which will also require a lot of capital, and clean energy, which was again a thrust area with 35,000 crores of investment. So overall, it was heavy capex intensive budget, which if you look at capex, it takes its own time to drive into higher incomes and therefore higher consumption. Government already had fueled that rally in terms of leading to private capex. A consumption boost would have been an easier approach, but government opted to do the same old-fashioned way of doing a capital expenditure, which will take a little bit more time to convert into economic momentum. What was also the highlight of the budget was there were lower handouts and subsidies. So government has preferred looking at infra and housing over spending like Manrega or subsidies. Manrega is they employ people in the rural areas and pay them on a daily wage perspective. So that and subsidies were lower. So in a way, the thrust is really in terms of not really giving people money, but trying to boost it through capital expenditure so that people get more jobs and more incomes, and therefore consumption increases over a period of time. Also, we saw a thrust on affordable housing of 79,000 crores, which was a significant increase. Of course, last year budget was lower, but again, if you look at the revised estimate, they're already done 77,000 crores for last year. So from that perspective, it's a small increase, but from what was budgeted last year, it's a significant increase. So this will help the housing market retain momentum. Again, housing is one area which has a cascading effect on the economy and also on employment. So from that perspective, also, we think that this is a positive. Again, while doing this capex heavy, they couldn't boost consumption because they had to be fiscally prudent. So they need to ensure that the fiscal deficit should be coming down over a period of time. And therefore, with that mindset, they couldn't do two things. They had to choose one, either a capex or consumption, and they have opted for capex, which we think that fiscally prudent is also essential to improve credibility in the foreign markets. Also, we saw green economy push, which is also a thing that we have been seeing sometime, that government probably has no choice but to showcase to the outside world that not only they are pledging towards being greener and cleaner, but also at the same time, they are having a thrust via spending and ensuring that the green economy momentum also kind of continues. So if you look at what's helping the capex push is higher tax collections. So if you see tax collections over a period of time have been increasing significantly, given that the GST collections, the direct taxes collections have been robust, which is helping the government to ensure that it could do more capex kind of activities. Otherwise, the fiscal deficit will be a problem. So this is, I think, a result of increased formalization that we have seen in the economy, which is a helping hand for the government to drive the economy with more capital expenditure. Also, if you see the capital expenditure over the last few years have been increasing, not only in absolute terms, but also as a percentage of GDP. So overall, we have seen that what government has done, opted, is to reduce reduce other expenditures from the total expenditure that they do and increase thrust towards capital expenditure, which is depicted in the right-hand chart, which is showing that capital expenditure as a percentage of total expenditure, which used to hover around 12-13%, have now increased to 22%. which is leading that government is not believing in making other expenditures like what we saw, subsidy or Manrega, etc., and looking at more thrust on capital expenditure, which could be a driving force in the economy. So overall, we think that there could be a growth multiplier, but growth multiplier will come over a period of time. Again, there was a green economy push. Government has announced a net zero target of 2070 and also a short-term targets for 2030. So there is a clear push for the green economy, and we could see in the budget numbers also, right from FY20 to FY24, if you see spending towards environmental activities has increased from 0.08% of GDP to 0.3%. And from an absolute amount perspective, it has increased from 154 billion to 899 billion. Also towards social activities has been inching higher. We saw some dip there because the government is not looking at more expenditure from a social perspective, because many of the schemes they are not spending, but opted other way around of doing capex, and therefore incomes of people in rural areas would increase. So overall, we saw a push towards green hydrogen with an outlay of 19,700 crores. There is a thrust on battery energy storage systems. There is a thrust on biogas plants. So there will be about 100 billion spent towards compressed biogas plants, which they intend to set up 200 of them. And also 35,000 crore for priority capital investments towards energy transition. So I think energy transition, climate change is for real, energy transition is required. India has made big pledges on the global stage, and this is a cause towards ensuring that we are on the right path. So the ESG kind of products would benefit as this really shows that government is serious towards the green economy, and therefore there will be more regulations that will come, and companies that are better prepared for tomorrow will benefit over a period of time. So I think ESG kind of companies, this is a good helping hand to ensure that these companies who have been doing much more and beyond for the economy, reducing their carbon emissions, will benefit over a period of time. So with that, these are the positives of the budget overall. We'll look at from a sector and from a fixed income market perspective, what are the changes that they have done, but there have been clear certain disappointments as well. So if you look at rural consumption, which was lagging post the COVID, it did not recover like the urban economies did. And that was a K-shaped recovery that we saw. Urban consumers doing really well, and rural economy, rural consumers not doing really well. So the cut in Manrega, the lower food subsidy bill, lower spending on agri and allied. If you see the right-hand side table, the total agri plus rural spend, though it is increasing, it's increased just a tad. And overall, I would say that the total spending since FY21 has remained more or less constant with a marginal increase. So overall, from a percentage to GDP perspective also, which was 1.77% in FY21, the GDP kept inching higher with a nominal growth of 10, 12%. But if you look at the spending as a percentage of GDP has been going down from 1.77% to 1.27%. So it's been a clear disappointment from that perspective, given that area of the economy was really lagging behind, which needed a push. And the push is given from a capex perspective, but it will take its own time to convert into rural incomes and rural employment. So overall, it's a capex heavy budget, but rural push would have really helped the cause. And the third thing that we're seeing is the gold duty reduction has not come in. So markets were really anticipating that, government will kind of reduce the duty because the differential between the international gold prices and the Indian gold prices is significantly large today. So overall, this is leading to various anomalies in market prices. Also, it is leading to some illicit imports coming into India. And therefore, to stop that, what we require is some rationalization. So we thought that they would start that rationalization, but that has not happened. So what was the impact? So markets, before going into the budget, were expecting a 2% reduction in customs duty on gold. but that didn't happen. So markets were already trading at a 2% discount to the parity rates. That discount has now narrowed to less than 1%. So overall, though gold prices have gone up, Indian gold prices have gone up slightly more because the duty reduction didn't come, which the market was already anticipating and was just pricing in the prices, gold prices. But given that it didn't occur, Indian gold prices inched up to that extent, removing the discount that they were trying to price in. So overall, it's a good budget. It's not a bad budget, given that they had to be fiscally prudent. They opted a longer road rather than trying to boost the areas where it was required. So slightly disappointed on that, but overall, it seems like a very good budget from our perspective. With that, I will hand it over to George to take you through how it impacts the equity markets, how it impacts the sectors overall. George, over to you.
Thanks, Chirag. Overall, from an equity market perspective, like Chirag mentioned, so on a directional basis, government has chosen the long-winded way of boosting the capex. So if you look at it from the ambitions of what the leaders have told earlier, so for India to boost its share of manufacturing and to be a manufacturing to become larger in that manufacturing space, it is obviously essential for our infrastructure to improve, the roads networks to improve, and the railway infrastructure has to improve. And the government has clearly prioritized that over prioritizing the direct, giving money into the hands of the consumer and thereby boosting some sort of consumption. But the major positive, apart from that capex boost was, this being the last full year budget before this government goes into election, we did not see any sort of major populist measure which would have hurt our fiscal balance position, and that was a clear positive from this budget. So in terms of boosting the consumption power, one was the direct outgo in terms of the subsidies and the Manrega outgoes, which is clearly on the lower side. The other way to do that is to give some sort of tax rebates or lower taxes for individuals. So although the budget had some tax exemptions for the new tax regime, where you do not have the option to choose those exemptions under ATC, which is about 1.5 lakhs for your investments. And again, there are other exemptions which you can claim if you have a housing loan or even investments in instruments like NPS. So all those benefits will not be available in the new tax regime. And since those benefits are given only in the new tax regime, so people who opt for the newer ones will lose all these deductions. And hence our sense is most of the people would opt to continue in the older tax regime where the tax rates and everything continues to be similar. So even in that perspective, there is no case where there could be benefits to the individuals on a large extent. So coming to the next slide. Yeah, so coming to the key sectoral impacts. So clearly there has not been any consumption boost, and therefore sectors like FMCG and auto, where the demand is driven from the individual per se, has not seen any positive outcomes or positive announcements from a pure budget per se. But of course, the cyclical recovery which is ongoing in the economy, that would continue, and that would ensure these sectors benefit over long periods of time. So agri and rural India, there has not been any clear announcements, and in fact, government has repurposed the outlay which it had done from last year towards more capital spend. Therefore, we have clearly seen some reduction in subsidies or even the allocation to Manrega, and that has all been diverted in terms of capex spend. Of course, the rural economy would benefit from some sort of infrastructure activity which would happen from the higher capex spend, but that would be slightly long-winded. You have to start the construction, and then once that infrastructure is built, you would see a lot of developments around that infrastructure. From an immediate perspective, the benefit would only be to the extent of the employment which is generated from those infra activity. So coming to the positive side of the budget, so the big infra push would ensure that the commercial vehicle demand is intact. And even banks, we would see the credit growth has been fairly good for quite some time. And with all this infra construction happening, we would see some bit of contribution to the credit demand. And that could help in terms of persistence of those high rates of credit growth. And that is true even for the building material space, where we would see a lot of demand in terms of building materials like cement and other ceramic products and things. So that is one clear benefit, where anything which has to do with construction and infrastructure activity would benefit. But of course, the consumption related sectors do not have any clear benefit. Next slide, please. So as far as announcements pertaining to financial sector is concerned, one big announcement was a removal of tax benefit on redemption of non-ULIP products with aggregate annual premium of more than 5 lakhs. So we have interacted with insurance companies post the budget announcements, and the general estimate is on an aggregate basis about 10 to 12% of their overall new business which they generate every year is at risk, and therefore we can expect some marginal negative impact because of that announcement, because people wouldn't be encouraged to have an annual premium of more than 5 lakhs, because the proceeds which whatever you get out of those policies would be taxed at your personal income tax rate, which could most likely be at 30% for most of the individuals who contribute more than 5 lakhs of annual premium. And therefore, to that extent, there is a marginal negative extent. But what we have seen when a taxation change happened in ULIP policies was the impact was actually much lower than what we initially anticipated. So what typically happens is probably, if there are more individuals in the family, they can opt for insurance policies to be spread between all the members of the family and all of that. So the broad impact may not be as severe as we see now, but in the worst case scenario, the impact is not going to be beyond 10-12% of the new business which these companies generate every year. So the other clear indication which the government has shown is, so government has been pushing everyone to adopt the new tax regime, where you do not have those deductions for investments into equity-linked saving schemes, or even the other insurance products and things. So that is, in fact, from a financial savings perspective, that's marginally negative. But if you look at the overall perspective, if we take the case of ELSS, there is just about 10% of the equity AUM which is in ELSS scheme, and the overall, out of the overall AUM, the proportion is just 11% as of the most recent disclosure. So the impact would be fairly limited. And if we look at India as a country, so we remain underinvested in these equity products. So the investment in equity of the is just about 4.8%, and hence we have a long room for improvement. So we may not see from where we stand today, we may not see a major reduction in equity flows because of this announcement alone. So there has been clear support towards the new age auto vehicles, electric vehicles, and the lithium-ion batteries. So if some of the auto ancillary companies are planning to venture into lithium-ion cells manufacturing and things, and for them, the duty on the machinery which has to be imported for that is removed. And that is the same case with even there's been a reduction in lithium battery imports in terms of the duties. And that would be beneficial for auto companies and associated firms. So that would ensure there is a push for EV, and all the auto companies would benefit out of that. Now, Pankaj would take us through the impacts from a debt market point of view.
Yeah, thank you, George, and thank you everyone for joining us today. And on the fixed income side, again, budget was positive, and it was positive on mainly 3 counts. One, the fiscal discipline. So government maintained the fiscal discipline. As we all know, during the COVID crisis in FY21, government was kind of forced to have a higher fiscal deficit. They were to spend a lot on the social sector, and their revenues shrunk. So fiscal deficit spiked, but thereafter you can easily see in this chart on the left-hand side that fiscal deficit has been coming down. And despite the last full budget before the election, they maintained that trajectory. So again, we had 50 basis points of fiscal consolidation. And again, they reiterated their commitment to move towards 4.5% fiscal deficit by 2026. So maintaining of fiscal prudence is a positive signal for the bond market. And the second part was on the quality of spending. So again, if you generate assets with your spending, your revenue generation capacity in future increases. And that again helps government balances. So you can understand fiscal deficit as a gap between the spending and earning. So deficit means you are spending more than you earn. And as it goes down, that helps. So one way of reducing that deficit is to reduce expenditure, what government has been doing for last 2-3 years. Another part is enhancing your revenue base. And that's what we guess will happen if they are investing heavily in capital infrastructure. And the third element in this equation was the borrowing. Next chart. Yeah. So on the market borrowing, again, market borrowing, if you compare with the pre-pandemic level, it is on the higher side. But again, it's trending down. And as they reduce the fiscal deficit, that's going to help and reduce the market borrowing. And at the same time, because of this rapid formalization, we have seen how Indian public started investing in all kind of financial assets, especially in mutual fund or even bank FDs expanded after COVID. So that rapid formalization has created additional demand for government bonds. Now, if you see the combination of these two, on one side, we are seeing government borrowing kind of stagnating in rupee terms and falling in as a percentage of GDP. While on the other hand, we see incremental demand coming from insurance companies, pensions for the government bonds. So that again make the demand supply balance in the bond market favorable. Though we might see some headwinds coming from bank side, because now banks are seeing increased credit demand, and they may not be very keen to buy government bonds, but there is enough space or demand for government bonds coming from other participants. So all in all, this was a positive budget for the bond market. And as the budget has been done and dusted, I think market will shift its focus quickly to the monetary policy. And even there, we see some positive developments. Now, last year, we had a very high inflation, and RBI was very aggressive in its policy unwinding. So the hiked rate, the money market rate or overnight money market rate has moved up by almost 265 basis points. You can see it in the reverse repo or the SDF, which is kind of operational rate as of now. It has moved from 3.35 to 6% in the last year. And at the same time, they reduced the liquidity from surplus of 11 trillion, almost 11 lakh crores, to now close to 2.5 lakh crores. So that was a significant policy unwinding done in 2022. But now, with so much of tightening already happened, we are yet to see the full impact of all this tightening. And on the other hand, inflation has started to ease somewhat. So even in the last 2-3 months, we have seen a very rapid disinflation coming in. So even on the monetary policy, we might see RBI pausing the rate hiking cycle. So they can keep the repo rate at 6 quarters for extended period. And in the past, whenever we saw RBI stopping after the large rate hike, most of the time we see bond yields coming down. And next slide, please. Yeah. Yeah. So you can see in this chart, this shows the long trend. And whenever after a large rate hikes, RBI stops, bond yields tend to come down. So we will probably see bond yields coming down in 2023. And from the bond market perspective, or from the investors' perspective, that bodes well for bond fund returns. One, you have a higher accrual yield. The starting yield is much higher than what we had for the last 2-3 years. And then there is a possibility of yields coming down. So it can add to the overall return on the bond fund. So we are kind of optimistic about bond fund performance in the years to come for the next 2-3 years. And for investors, I think it's important to understand their own risk appetite before investing. So though we can gain more by investing in longer duration funds at this time, but if you have a shorter holding period, I would suggest you stick to liquid funds, good quality portfolio, liquid fund investing in government securities, PSU sector, what we offer in our quantum liquid fund. And if you can tolerate some bit of volatility and hold for longer period, I think dynamic bond funds are very well placed in this environment. So they might benefit out of interest rates coming down. Now, just to summarize what we all discussed, broadly, budget was focused on capex. They maintained fiscal prudence and boosted capex. But for the equity market, again, there's always some trade-off. And in this environment, the talks is about valuation being a concern. On the rate side, again, fiscal prudence has helped. But it might take some time for yields to come down, and there are risks from external sector, especially what is happening in US, Europe. And on the gold side, on gold, there was a cut in duty, but we might see some volatility. Again, macro environment is still highly uncertain. So budgets can come and go and all things can happen. But in all this uncertainty, you need a portfolio which can offer you more stable outcome. And we believe in Quantum that this 12-20-80 approach can deliver on that. So all the overall budget impact is going to be positive for the 12-20-80 portfolio. But even beyond that, I think people can bet on this portfolio to deliver a stable return over the long period. Next slide, please. Just to tell more about discuss more about the 12-20-80 portfolio. So first rule of investing is to have some backup planning, right? So before you go for investing, just take out some money for your emergency or any contingency needs. So in this case, we recommend at least 12 months of your expenditure should be set aside somewhere safe. It should be invested in kind of asset where you don't feel much of risk and don't face much of risk. So you can invest in a liquid fund or bank deposit on those kind of assets. Then rest of the portfolio you can divide into two parts: 20% in gold, which has which acts as a diversifier. So it has a tendency to react in opposite direction when you see very large move in equities, especially on the downside. So whenever you see very large drop in equities, gold usually comes for the rescue. So gold can act as a diversifier, while bulk of your portfolio should go into equities, which have a very long history of generating wealth, and that can boost overall portfolio performance. So in Quantum, we offer funds in all the three categories, and you can easily fill the entire bucket with Quantum funds. So for 12-month emergency corpus, you can keep it in Quantum liquid fund, which invest only in government securities and PSUs. For gold allocation, you can choose between Quantum Gold Saving Fund or Quantum Gold Fund. And for the equity section, because there are different kind of styles in the equity market, and we don't want your portfolio to be biased towards any one style, is better to divide that portfolio into three parts. where you can invest 15% in quantum long-term equity fund, long-term equity value fund, which follows value style of investing, 15% into ESG fund, which is more sustainable kind of investing, and then 70% bulk of the equity portion should go into quantum equity fund of fund, which actually invest in other equity schemes of other fund houses. So give you very diversified investment across various kind of styles. So that can fill most of your needs in terms of your saving or wealth generation journey. You can also achieve this through passive investment by allocating to quantum Nifty 50 ETF fund of fund, or in case of gold, you can invest in the quantum gold ETF. So all in all, this 12-20-80 portfolio is a all-weather kind of portfolio which you can invest and carry for long period for your savings and wealth generation. Next slide, please. And good thing is this is you can customize this entire portfolio allocation as per your need, and you can make investment with only few clicks, and all that tools are available on our website. I'll highly recommend all of you to just go and check that tool. So as you can see, for example, you can just enter your expenses, total planned investment and your monthly expenses, and the calculator can immediately throw the entire asset allocation across all kind of funds, and you can invest in few clicks. So that's all on the 12-20-80 approach. You should go and check it out. I'm sure everybody will benefit out of it. Next slide, please. So that's all, and with that, I'll hand over to Neeraj for the Q&A. Thank you.
Thank you, panel, for the insightful presentation. I'll request all our listeners to post their questions in the chat box, and we'll try to answer all of them one by one. My first question to you, Chirag. Apart from 12 months liquid fund suggestion alone, there is no actual debt allocation in our 2080 model. Since you suggest 20% gold and 80% equity, so where is the scope and real place of debt funds? Is just gold and equity alone sufficient with just two asset class? And what about a third asset class, debt? Because now debt is rallying very well. So won't people or investors miss out debt as an asset class? Are we against debt funds?
No, not at all. We are not against the debt fund. Only our view is this is a customized or an approach that a retail investor can have. And many times retail investors do not understand the impact of what the negative impact of debt funds can be. Like, for example, they treat a debt fund as an alternative to fixed deposits, and that they cannot give a negative return, whereas in reality there could be a negative return from a debt fund as well. So given investors find it difficult to comprehend and understand, that is why we have not. But someone who really understands the debt markets is willing to take on that volatility if that occurs, willing to give a larger time frame to their bond market allocation, then probably they can carve out a portion for their bond allocation. For example, this 12 months, that can be increased to say 12, 24 or 36 months. And the part of it can be allocated to bonds. For example, what we do in our quantum multi-asset fund also, we do have an allocation to debt, equities and gold, but a large portion of it is into liquid, but there is an allocation to debt as well within that. So given we understand the bond markets, we understand the impact a rising interest rate environment can bring to the bond markets, we kind of carve it in a way that it is we have a lesser negative impact. And if someone understands that market, they can carve out an allocation to debt within this 12, 20, 80 allocation as well. So if you go onto our website, there is a calculator wherein you can allocate to the bond fund as well. So overall, there is nothing that you can't do, provided you understand that asset class, that fund very well where you're investing into. So we are not against that. We are not against a bond allocation. We, as Pankaj, in all our presentations, highlight where is the bond market moving, and that is for a reason to educate investors on how the bond markets can move, what are the positives, what are the negatives that come along with it, and therefore they can take an educated call if they understand that well. But an average investor, given that they compare a bond fund to a FD, which is not the right thing to do, and that is why we don't give an allocation. We want to keep it very, very simple. And from that perspective, even a 12, 20, 80 allocation with 12 months into liquid and 20, 80 into gold and equity will also suffice. Had it not sufficed, we would have it advise that to them. But if someone wants, they can easily carve out a bond allocation to it. So I hope I have clarified clearly. We are not against a bond fund or a bond allocation, provided investors should only venture if they understand that space very well.
Thanks, Chirag. There's a continuation of questions. With almost no need for submission of any tax savings in investments in new tax regime, will ELSS tax saver funds be required at all going forward to cover for Section 80C? Does this type of scheme become redundant?
No, currently still there is an option. Of course, the view of the government is to, over a period of time, move towards the new tax regime. But still there is a need for old and new, because if you see for certain type of people with all the benefits that they can get or all the deductions that they can get or they can claim, there is a possibility of a lower tax on them because of the advantages that it brings to it in being in the old tax regime. So overall, till that distinguishing factor remains between an old and new, and there is an option available, there will be a class of people who will want to go for the old tax regime and ensure they get the benefits of deductions that come along with it, either through ATC investments or through housing loan or through HRA or through NPS. Those kind of deductions may help them get a lower tax, and therefore there will, till that two options remain, there will be a need for any ELSS investments, because out of that ATC bracket, I think ELSS makes most sense, and therefore that will continue to be until we have that option. Post that option is gone, given that that is a very small allocation of the overall equity pool, that tells us that people come to mutual funds because they offer much beyond as a saving investment, an option which is much beyond the tax benefit that it provides. So I think overall the attractiveness of mutual funds still remain, but if there is only a new tax regime that remains over a period of time, then probably the ELSS funds may not be required. But until we have an option, ELSS stands to benefit.
Thanks, Chirag. George, my next question to you. There is a news that value theme will do well over the growth this year. So what's your view on that?
Yeah, see, value typically does well when generally the interest rates goes up, and then so interest rates going up has an impact on your cost of equity, and that cost of equity would have as a bearing on the PE ratios and all those the high valuations which you see in certain set of stocks. So value stocks typically by nature they have lower PEs or lower expectations on future cash flows of that company, and since your expectations is low and the valuations are in a much more reasonable phase than those the growth high PE cohort, you may not see the kind of impact which you see on in those the high PE stock or the stocks where large quantum of future cash flow is factored. And to that extent, so the general expectation is the interest rates are likely to remain high in this year. and therefore, value stocks as a cohort is likely to do relatively better in probably in the medium term and even the current year.
Thanks, George. Pankaj, my next question to you. Any reallocation required in 2023 between debt versus equity, depending upon the yield expectations and global macros?
I think that depends on investors' own asset allocation, how or their risk perception, whether they want to be in equity or debt. But I think we should not make these adjustments based on very short-term market moves, especially in case of equities. So, but overall, if we see, definitely their outlook for debt has improved and improved a lot. So incrementally, if anybody is willing to allocate in debt, I think they can move slightly higher on the spectrum and invest in slightly higher duration fund if they can tolerate the volatility and they understand that market. But I don't see much of churning because of very short-term market moves. Maybe Chirag can add more on that.
Yeah, I think what Pankaj said is I'll agree to it, that it shouldn't depend on because attractiveness of both the asset class today is very high, given that the capex will lead to better returns in equities over the medium term and the long term, and also debt market, given that the potential of inflation coming down and yields going lower could help bond markets as well. So none of the markets are at extremes. Both markets look attractive from a medium-term perspective, and therefore the possibility to make returns is there in both the asset classes. So overall, it will depend on what your overall appetite and overall risk asset allocation is today. And therefore, you need to craft and remember one thing, that there is a need for each and every asset class in the portfolio, and each and every asset class is there for a reason. Equities will generate that long-term better returns. Debt or liquid fund would add to the stability of the portfolio, and gold is there for diversification. So overall, these things shouldn't be ruled out in any market scenario because you don't know when the uncertainties and from where they come in. This is the scenario as of standing today. Tomorrow, some more details may come in, and that could change things significantly. And therefore, you need to be placed adequately in each of the asset classes. And given the current scenario, I think a well-balanced portfolio will augur well, rather than shifting allocations big time in your portfolio.
Thanks, Chirag and Pankaj. George, my next question to you. What is the quantum's exposure to Adani Group and Patanjali? And there is in continuation with this question, what is the impact of this particular stocks in our equity and debt funds?
Right. First of all, I won't be able to comment on specific stocks, but I would give an overall overview of how we select stocks and about our process. So Quantum, since inception, has a very strong governance filter. So with that governance filter, what happens is we weed out companies which has questionable practices in terms of business development, or where the core competitiveness of that company or the growth profile is not reliant on a specific nexus with a government party or it's not very highly regulated in nature. So we prefer companies where which has sustainable cash flows and which can fuel growth with those inherent cash flows which the business generates. So what eventually happens is with this strong governance filter, we end up so the outcome is we weed out companies where where there is excessive leverage, or where we see it's the business growth is not sustainable with the kind of cash flows the companies generate, or that firm in itself does not have that the kind of parentage to sustain capital raise or the capital requirements in future. So with this filter, we kind of we are able to avoid a lot of groups which come up for all the wrong reasons in the news and things. And that is a very strong contributor to long-term performance. Of course, there could be years where some of our filtered companies or filtered companies run up a lot, and that affects our performance a lot. But over a long periods of time, this process has helped us, and has helped in two ways. One, the returns in a return perspective over the long periods, and number two, in terms of reducing the risk of the overall portfolio. So that would be my brief answer to that.
Neeraj, just to add to what George said, from an exposure perspective, you can see our fact sheets. So for example, in the debt funds, we don't take any private papers. So we don't own anything in that group. Even from an equity perspective, given the emphasis on corporate governance that we have, a long history of management, etc., that we see, we do not have any exposure to that group in our actively managed equity funds that we have. Passive, it's part of the index, so we don't have a choice but to mimic that index, and therefore there could be some exposure there. But otherwise, in any of our active funds, that is the Quantum Long-Term Equity Fund, Quantum India ESG Fund, we don't have any exposure there.
Thanks, Chirag and George. Chirag, next question to you. What is the difference between active and passive investments?
Sure, that's a good question, I think. From an active perspective, it is when you say it's an active fund, it is a fund which takes active calls, which could be very, very different than the index. And in a passive fund, there is an index. Then the fund manages each and every stock or buys each and every stock in the proportion of that index. So if the fund, say a stock in an index is say 10%, then the fund will also buy that up to nearly closer to 10%. It doesn't take any active call in terms of whatever is the index weight, I mimic that weight. Whereas in an active, they take based on their mandates, based on their style, based on their processes, they will construct the portfolio in that manner without having much bearing on the index. Whether it is, for example, both the funds that we have in the active space, the Quantum Long-Term Equity Value Fund and Quantum India ESG Equity Fund, are all both benchmark agnostic fund, means they don't look at index weights before weighing any stock in the portfolio. So there are many stocks which are very heavy weights in the index. We don't have any allocation to those stocks. Whereas there could be some stocks which are outside of the index or the benchmark. So the fund will take a call based on its mandate and where they think there is a maximum opportunity available, and therefore weigh them in their portfolio. So active is choosing your investments based on your style, based on your mandate, based on what you think is more opportunity driven. Whereas in a passive fund, the fund manager does not take any call on the stocks. They replicate an index. For example, the Nifty ETF that we have, they will buy all the stocks that are in the Nifty 50 index and replicate nearly to the same weight for each and every stock that is part of the index. So in an active, the fund manager and the research teams take that call in terms of how they weigh each stock or what stocks to buy and how they weigh it in the portfolio. In a passive fund, the fund manager does not take any call and buy the stocks that are part of the index in the nearly the same proportion that they are weighted in the index. So active does active calls and passive does not take any call.
Thanks, Chirag. There's one more question on gold. How Quantum Gold Fund is different from Sovereign Gold Bond?
Yeah, so there's a very, very big difference between both the two, both the things. The Quantum Gold ETF is listed on the stock exchanges. Each and every unit of the Quantum Gold ETF is backed by physical gold, 24 karat physical gold. They store that the gold is stored in secured professional vaults, and it is 100% insured. So there is no risk of purity, etc., which comes along with physical gold. Each and every unit is 0.0 0.01 grams. So you can buy a very small quantity at very wholesale prices. So it brings you the price efficiency much better than you buying physical gold. And the biggest difference between a sovereign gold bond and the gold ETF is sovereign gold bond is not backed by physical gold. There is no gold underlying the bonds that are issued. There is a sovereign guarantee by the government saying that, whatever on redemption, whatever is the gold price, I will give you that much money to you. So instead of buying any gold, there is no gold underlying there, and the government makes sure that you get the gold price on redemption. Now, both the instruments are listed on the stock exchanges. The only difference is, given there is physical gold underlying the gold ETF, they trade very close to the physical market, wholesale physical market prices. Whereas sovereign gold bond, usually we have seen that they trade at a discount. So gold ETF is very, very liquid. Sovereign gold bonds is at most times illiquid because there is no fungibility. There is no gold underlying. There is no market maker that can come to the fund, like in a gold ETF, saying this is the units I have purchased from the market. You give me gold against it. The sovereign gold bond, there is a lock-in for everyone. And therefore, investors at times when everyone wants to sell, there will be typically a discount because of, and therefore the illiquidity and the discount that comes along with it. So if you're looking from a portfolio perspective, and one more difference, sovereign gold bond pay you interest on and above the gold prices. Gold ETFs do not pay any interest. So from a return perspective, sovereign gold bond may give you slightly higher returns, and that may appear good at this point in time. But when you try to sell that, because at some point in time, you may have to rebalance the portfolio. Say if equity markets fall from here and gold keeps rising higher, you may have to change some allocation from gold, book profits there and move into equities. At that point in time, if you have that illiquidity discount, whatever earnings that you may have may get washed away because of the illiquidity discount that you have to get because you have to sell it on the exchange. So, so these are predominantly the differences between the two. But when it comes to a portfolio context, we think that gold ETFs score significantly, given they are very, very liquid instruments backed by physical gold, are a preferred form of investing for investors rather than the sovereign gold bond.
Thanks, Chirag. There's some question on there is a capex investment is coming year in coming years. So REITs are good for investments.
Maybe I'll take that question.
Yeah, please.
So I'll just first start with what REITs are, and then we would I'll explain that. So REITs are essentially so whatever REITs are available in the market, that is a collection of the commercial buildings which are typically available. There is no regulation that it should be only the commercial office space, but it's predominantly the commercial office space and the retail malls which is currently in the business. So of course, with a lot of infrastructure development, REITs, you would see once roads, a lot of roads are construction, you would see buildings coming up next to that, or even there is possibility of more job opportunities and things. So eventually REITs would benefit. But whatever REITs are available in the market, they are predominantly in certain geographies, predominantly focused on the metros which are existing, and where the inventory or the scope for expansion would be limited. So what has come up in the recent budget is REITs typically. So the direct answer to that is that may not that REITs would benefit over a long period of time, but that may not be an immediate benefit in the next 2 years or 3 years, because it takes time to build the infrastructure and the commercial spaces to come up close to that. And REITs typically, they do not retain a lot of cash flows which those assets generate. 90% of those cash flows are distributed to the investors. So what the recent budget has done with REITs is REITs typically return money to the investors in 3 forms. One is in the form of debt repayment. The other is in the form of the interest for the money which they have taken from the investors. And the third is the typical dividend. So in the current regime, a lot of the REITs had classified majority of the cash flows which they returned to the investors as debt repayment. And so that debt repayment was tax-free until this year. And the budget has proposed to impose principal at the marginal tax rate. So from a tax perspective, the receivables which you receive from REITs would be taxed at a higher rate going forward, going from the next year. So to that extent, you have to factor some reduction in your returns. So as far as the dividend yields are concerned, under the current quoted prices, most of the REITs are, giving you a dividend yield of almost somewhere between 7 to 8%. Of course, there is a possibility of capital appreciation of those assets which these REITs on. But as we stand today, the dividend yields ranges between 7 to 8%, and there would be a higher tax incidence on those the proceeds which you get from those REITs compared to previous years, which could be to the extent of about 1 or 2 percentage points, depending on the tax slab in which you are taxed.
Thanks, George. There's a question, George. There's a question on would the reduction in tax rates lead to a consumption boost?
See, as Chirag explained in the initial part of the presentation, so most of the reduction in tax rates has come up with a new tax regime where you do not have an option for deductions against investments, which is the typical section is ATC, which is 1.5 lakhs. And if you have deductions like HRA or even other investment avenues and things, or even interest payment for education loans and things, all those exemptions are not available in the newer tax regime. So when we did a very conservative estimate, considering a typical quantum of deduction which an individual has, until a very large taxable income like about 50 lakhs or 60 lakhs, there is no clear benefit of those newer tax regime. So from a consumption point of view, in order to boost consumption, the citizens needs to have more money in their hands, which is clearly not happening, at least in the medium term, at least probably in the next 1 or 2 years, based on the change in the tax rate. We don't know if something extra would come up in the next budget, which stimulates more people to shift to the newer tax regime. But as of now, that looks unlikely, and purely based on that tax rate changes of the new tax under the new tax regime, we don't see a very large case for lower taxes and therefore a consumption boost for the individuals.
George, next question is, can NRI invest in mutual fund and can take especially in the ELSS scheme to take the income tax benefit?
See, most of the cases, NRIs, they do not have taxable income in the country, and therefore, that may not be relevant in terms of taking those deductions under ELSS scheme. But of course, equity remains the best asset class in terms of beating inflation. And in order to meet your long-term goals, it is always advisable to have a good allocation towards equity. So I would urge you to continue investing in equities, despite that tax benefit or tax disadvantage. Not a disadvantage, you do not get a clear tax benefit in that case.
Yeah. There's a question, George. In budget, there is an announcement for some sort of positive push for agri startups in light of reduce of subsidy to fertilizers. Can you throw some light on this?
So the subsidies has reduced almost by slightly more than about 20%. But what we see in the international market is the subsidies for fertilizers. So what we have seen in the international markets is, even the fertilizer prices have started reducing. Probably the government could have, assumed that while putting those estimates. So therefore, in terms of the quantum of fertilizer which a farmer can afford based on those subsidy numbers, it does not materially change. So to that extent, it could be neutral. And what we saw in the last year was the revised estimates were much larger, much higher than the budgeted estimates which the government had for fertilizer in the last year. So as such, there is we don't see a very clear benefit as far as agri agri sector is concerned on a direct, a money transfer basis. But it could be kind of neutral. And overall, we have seen the crop prices moving up and things, and that could kind of benefit the agri sector. And that is visible even in demand of tractors and things. So naturally, this year should have been a down cycle for tractors, where we still see good demand at double-digit growth rate kind of things, which says there is some early signs of a recovery in the rural sector.
Thanks, George. Pankaj, my next question to you. Do you believe 4.5% fiscal deficit is achievable?
See, definitely their revenues are growing, and we see nominal GDP picking up, even with a nominal assumption of 6.5% real GDP growth plus 5% inflation. Most likely we'll see the denominator in that fiscal deficit to GDP number growing at 11.5%. So yes, there will be some pressure to lower the revenue, lower the expenditure, but it looks achievable. But definitely for the next 2 years, government will have to be a little aggressive in cutting expenditure.
George, next question to you. As currently we cannot, there is a question, a stock specific question, but so I'll just say that according to you, looking at the current budget, which sector would be more beneficial?
Right. So clearly, whatever sectors which are direct beneficiaries of higher government capex spend or infrastructure development, those will be the sectors which are beneficial. So from a sectoral point of view, if we look, banks would be a good beneficiary. So we have been seeing a reasonable credit growth in the last few months, few quarters. And with all these activity happening, there would be demand for more commercial vehicles. There would be more credit demand from the infrastructure development companies, the capital good companies. So all of that augurs well for the banking sector. So the banking credit growth, it might moderate from the current high rate of 14-15%, but we expect the credit growth to remain at healthy double-digit levels. So that is one sector. The second would be the cap goods sector, where they would get orders for all these, the infrastructure development and things. So even materials like cement and other metals, all of that which is used in building infrastructure, even those sectors would be clear beneficiaries. So anything which has to do with consumption, there is no direct benefit from budget, but of course, this would have an indirect or a second order benefit even to those two-wheeler companies and things like that.
Thanks, George. Chirag, next question to you. This is an interesting question. The risk of being invested heavily in passive world. Passive would have also led to investing in names like Adani, given that they form the part of the index. With that in context, do you think it is better to have a higher split towards active management than passive?
Of course, I think that, people tend to forget and have short memories. When going goes good, everyone says that, this is the way to it. But not only in India, but any market, you can't rule out, a corporate governance filter, because that's always an essential and a yardstick. And that's why in all our investments since our inception, we have a strong emphasis on corporate governance. So if you look at indexes, the way they are made, they have a weighing on liquidity and on market cap. See, means the most popular stocks, most biggest of companies get into it. It may not be the best of companies because there is no corporate governance filter built into making these indexes. And therefore, you might get, all kind of companies which may be big, which may be popular, but not really the best of breed. Therefore, if you have to get the best of companies, the quality companies, which are really good, their managements are good, their boards are good, they have no history of minority shareholder flouting, you need to invest in those companies for the long run. And when you can invest in only an active I, which has an emphasis on corporate governance in a big way, will be able to scout the bad actors and will be able to invest in good companies. And therefore, you need to have, I think active is the right way. Also, given the market inefficiencies that we have in India, plus the need for looking at corporate governance very, very deeply, I think active in India will be more beneficial for investors rather than passive. So even if you look at the index construction in India, the churn that index constituents have, etc., our indexes are also not very, very efficient from that perspective. So overall, all encompassing, I think active is still the right way. And given that until you have the market efficiency or the need for a very strong corporate governance, which I think we'll always have in an emerging market like India, you need to be in the active space more rather than the passive space. Passive can be a smaller allocation or a temporary allocation. But as and when you find the right allocation, right funds, you need to move on the active side of things. So I think I'll still prefer active or passive in Indian markets.
Thanks, Chirag. Chirag, there's two questions on gold. What are the difference between gold funds, gold savings funds, and gold ETFs? That's one. And why did gold price move up after the budget?
So there are three types of funds, right? In gold, one is the gold ETFs, as they are called. We call it the quantum gold fund. If you see the Q gold fund written here, it's a quantum gold fund, which is an exchange traded fund. So ETFs are available in very low denominations. They trade on the stock exchanges. So as you buy a stock, any company shares, you have to similarly buy on the exchange platform these units of the gold ETF. So, so as every stock will have a ticker, the quantum gold ETF has a ticker of Q gold half. You can put in Q gold half and you can buy it like you buy any other stock. The quantum gold saving fund are funds that invest in the ETF. So ETF will invest in physical gold. Quantum gold saving fund will invest in the quantum gold ETF. So if you don't have a demat account, or if you want to do an automated SIP, these funds are very, very helpful. Or say you don't want to transact on an exchange platform, you still want to buy gold very, very efficiently through these funds, then quantum gold saving funds are a better alternative. They are very, very convenient. So quantum gold ETF, that is quantum gold fund, and quantum gold saving fund are nearly the same. Quantum gold ETF invests in physical gold. Quantum gold saving fund will invest in the gold ETF. That is how they are built. Now, there are third type of funds, which are called gold funds, which invest in gold mining company shares. So the exposure they will have is either directly or indirectly through a fund, being a fund of funds, into gold mining company shares. So that they tend to give you an exposure to gold mining companies. But whenever you invest in a gold mining company, we have seen that time and again, they are more correlated to the stock market rather than to gold. So they are stocks first and gold secondary. So when you come, and they are very, very leveraged, right? In terms of whenever gold prices go up, they'll go up much more, and gold prices fall, they'll go down much more. And also when equity markets fall, they may also fall despite gold holding well. So they are not a very good diversification vehicle. They may give you leverage, but again, at times they are very, very inefficient. So overall, when it comes to gold, investing in gold, I will suggest that investors restrict themselves to either the gold ETFs or the gold saving funds, as they are called, rather than venturing out into gold mining companies. Because mining companies tend to provide a similar exposure to what your equities will give you at times, especially when stock markets are falling. So they fall together and devoid you of the diversification benefits that gold bring to the table. So overall, I think you restrict yourself to a pure gold exposure through a gold ETF or a gold savings fund.
Yeah. Chirag, the question is, do you have a direct investment channel to the customer, or we have to go through the agents or brokers?
So we have both. So it depends on how you invest or if you need a helping hand or not. So we do offer a direct plan, which is directly come to our website, invest yourself if you understand the products well, or you could talk to us and then invest. Second is if you think that in our overall planning, you need help of a financial advisor, even you could use that route and you could come into our regular plans through that channel of distribution or agents and invest into our funds. So we do offer both. It depends on what's your convenience, what's your ability to do things directly, rather than and invest the way you want, in either into the direct plans or into regular plans through an advice.
Thanks, Chirag. Pankaj, next question to you. Where do you see bond yields a year from now?
Definitely the direction is towards downside. So we expect yields to go down, as I shown in my presentation, that whenever RBI stops after hiking rates so much, we see bond yields going down. So there is a very strong tailwind from monetary policy cycle turning globally. So we see similar kind of trend in US, Europe, where last year there was very large rate hikes, and now in 2023, most likely they will stop, or there is also expectation building up of cutting rate towards the year end. So directionally, it should go down. And if you have to see how much they can go down, just to give a general sense, if repo rate is at 6.25, currently 10-year bond yield is trading around 7.3%, 7.30, which is more than 100 basis point spread over the repo rate. Now, if you look at the long-term average of this spread, it is very close to 90 basis points. But if you look at this spread after completion of rate hiking cycle, you find that spread has been much narrower, closer to 20 to 30 basis points on an average basis. So there is a good, decent room for yields to fall over the period. But I think this will be more likely second half story in 2023. But yes, directionally yields are heading lower.
Thanks, Pankaj. Chirag, there's a question on, again, on active and passive. Do active management funds have higher expenses than passive ones?
Yes, active does have higher expenses than passive ones. Passives are very low cost vehicles, whereas active are, and that is for a reason. So in a passive fund, there is no research team. There is no fund manager. I mean, there is a fund manager, but the fund manager, fund manager does is just to mimic the index. They just buy whatever stocks there are indexed in the same weight that they are in the index. So there is not much from a research and investment perspective that goes into a passive fund. Whereas in an active fund, you have a team of analysts, you have a team of fund managers. This team does a lot of number crunching and goes and visits plants, factories, talks to management, does channel checks, does a lot of research. And given that the team is large and there is no team virtually in a passive fund, and therefore the cost of an active will always be higher than a passive fund. But again, passive comes with its own risk, though it is low cost, and that's an advantage. But it comes with their own risk in terms of, looking at just that index, but there could be opportunities outside the index which will not be able to tap, whereas an active fund will be able to tap opportunities across the market that are available. And given that active has a team that kind of scouts for those ideas and therefore builds their portfolio, they will have an edge over a long period of time. What has happened over the last few years, there has been some polarization, certain few big stocks driving the index gains, which may not remain all through. There would be a broad market rally when there is an overall participation. Active funds will emerge as winners as opposed to passive. So overall, just don't look at cost or a tax advantage in any investment that you make. That's not the main thing to decide. That's a criteria that you should look at, but that's not the main reason why you invest in any instrument or any asset or any fund. You need to look at what are the opportunities that I get, what are the risks that come along with it, and thereafter take that call. Of course, you look at what cost it is, but are the benefits outweighing the cost or not? That is the call that one needs to take. Or what happens when the index performance or the market performance is beyond the few stocks that are contributing to the index. And that should drive the decision making rather than the low cost.
Thanks, Chirag. George, next question to you. In recent time, trend of investing in US stock is increasing. What are your views? Is it safe, better, or good to go with investing in US stocks?
Yeah, you can so invest in foreign market stocks, and those markets perform in different cycles compared to how emerging market function. But before investing, you need to ensure that the manager whom you're interesting to invest in those foreign markets has the expertise to understand those stocks and their cycles in a fair way. So it is always good to invest in foreign markets, but the main challenge as an investor sitting in India has is in terms of understanding those stocks in the overseas market. Chirag, you want to add something?
I mean, if you look at the overseas, yes, it's gaining momentum. We have seen increase in investor investment in overseas markets over the last few years. And that's a wise decision to diversify some of the exposure that they only have to Indian markets, whereas global will give them much more opportunities. So from a diversification perspective, yes, it does make sense to invest overseas. But now what are the instruments that you go into when you invest in the overseas market? One is directly investing in overseas market into stocks. Again, if you don't understand that, don't venture into it. You don't know when themes change, when things go out of favor or things are overvalued. If you're not able to track that well, probably it's better to go through a fund. Also, if you look at the recent budget, any investment above 7 lakhs will attract a TDS of 20%, which was at 5%. Now it will attract a TDS of 20%. So your 20% will be the tax deducted at source, which you can claim in your tax returns. But till that time, it will get stuck as a ideal money kept aside. So overall, given that if you intend to invest a higher amount, then that route also becomes inefficient. And therefore, rather than direct investing, if you don't understand that market well and this tax anomaly that has been introduced, you will be better off doing it through a fund and giving it to expert that could understand that better rather than doing it yourself. So there are various ways into allocating, and I think a more diversified approach even to investing in that market will be better. So if you see the decade from 2000 to 2002, 2003 to 2011 was of emerging markets. Post 2011 till 2021, 2022 or 2021 was a decade of developed markets. US markets did really well as compared to emerging markets. So these trends keep changing, which will also keep happening as we go along. And therefore, giving it to expert or having a well-diversified exposure to, say, a developed market, an emerging market, etc., will be more helpful rather than you chase returns in any one market. So overall, I think I will suggest that you go through a fund rather than going through direct investing, because understanding each and every geography, each and every market is difficult, and because of the introduction of these TDS in this budget.
Thank you, Chirag and George. Chirag, next question to you. Looking at the current market scenario, what do you would suggest to the investors to do SIP investments or a lump sum investments?
Yeah, so I think given that, all markets look attractive today, if you look at equity markets from a medium-term perspective, look good. Debt market also from a medium-term perspective look good. But if you look at, you can't rule out volatility. There are headwinds to both of these in the near term. Look at valuations in India compared to valuations globally. India is an expensive market, though historically speaking, we are very close to the average levels, average PE levels. But as compared to other markets, there we are expensive. So there could be some time or price correction, which we cannot rule out. And though the medium term scenario still looks promising. So I think a staggered investment will be a better approach in this kind of market. If corrections happen, then you can go lump sum. But if you were to take a call today, I think staggered investment in both these markets, not a long-term drawn allocation, but 3 to 6 months you can use to build your allocation to equity and debt both. And also the gold market, because gold is also at all-time highs. There are headwinds in terms of Fed still not done with their interest rate increases, and therefore there could be more volatility, and therefore it is better to stagger out our investments over 3 to 6 months in each of these markets and build your allocation.
Thanks, Chirag. Chirag, there's one more question on active and passive funds. We have seen recently passive funds and ETFs have performed better than active funds. Most of the active funds are not beating their benchmark as well also. So your views on that, and does Quantum use artificial intelligence in its investment strategy?
So I'll take the second and the question first. We believe more in human intelligence rather than artificial intelligence. So we have team of analysts, team of fund managers who will do the hard work in terms of going on the ground, verifying things, understanding things more closely, and then take a call. So we think that human intelligence will trump over artificial intelligence in investment world. There is still a need to make subjective judgments. And I think that will be better done with a human judgment rather than an artificial judgment. So I think we clearly believe in that human taking the call rather than machines taking the call in that perspective. So we have large teams of analysts and fund managers that do all the work. Coming to the first question in terms of active versus passive. So I think active has done well over last few years. And if you see, the performance of the index was driven by a very few concentrated stocks in the index. It was not a broad market participation that drove the performance of the index. Also, there was a lot of money from EPFO pensions coming to index investing, and that also drove the performance of the index. But as we go forward, we think that, there is a possibility that as economy recovers, there will be a broad market participation as different sectors will do well over a period of time. And therefore, given that performance will move over a period of time from this polarized, from this concentrated performance to a more broader performance, active will have its day. So overall, we think that active is still a better place to be as compared to passive. Again, you can't rule out the corporate governance issues that may come, which active can take shield against in terms of doing their homework and therefore taking that better call, which again, coming to your second question, that artificial intelligence will not be able to take those calls when it comes to trying to find out if there could be corporate governance issues. When we talk to people face to face, when we shake hands and we don't get 5 fingers back, we don't know that these managements can't be trusted, which an artificial intelligence will not be able to do. So I think in both the arguments, I think human intelligence and on the active side will be better as compared to artificial intelligence and the passive side of investing.
Thanks, Chirag. George, next question to you. What is your outlook on pharma sector?
Yeah, so we are quite positive on pharma sector generally because it is a very essential thing, like you see in your staples or or some other sectors where, you cannot live without those, medicines and those consumables. So, but what we saw in the last few years was, there was very heightened intervention from the regulators, the foreign regulators. And we saw a lot of plants, a lot of those plants which manufacture those the medicines and products getting under the foreign regulator scanner, and therefore a lot of the launch plans of these pharma companies were kind of deferred. And that was one part of the story. The second part of the story was there was some bit of consolidation among buyers in the US market. And therefore, we saw very large kind of price erosion in those in US generic market, which is a large revenue contributor to Indian pharma companies. So both these scenarios, we are seeing some kind of stabilization. One, price stabilization in terms of the US market, and number two, a lot of companies have managed to either get their plans out of those warnings, or they have kind of shifted those key products to plans which are functioning well. And therefore, our expectation is for a lot of companies, you would see their launch pipeline again, coming up in a good way, and that contributing to their revenues and profitability. And again, the US market price erosion has kind of settled, and even that could benefit the pharma companies. So we have a couple of pharma companies in our portfolio, and which is about 6% weight as of now, and we are quite positive on those companies.
There's one more question, George. Would reduction in rural spend have an impact on rural recovery?
So one, like I said, there is very early signal of some kind of pick up in the rural economy. So that's one thing. And the other thing is, a lot of those. So one, of course, withdrawing almost 1.5 lakh crore of liquidity from that market in terms of lower subsidy or lower spend to Manrega is not a good thing from a rural consumption point of time. But there are natural drivers which are looking good for the rural economy. That is one thing. And the second thing is, a lot of those reduction has happened in the fertilizer subsidy, which I feel the government would have factored the potential correction in those fertilizer prices, which had gone up in the last couple of years. And that could be one reason for lower allocation to those, fertilizer subsidy. But in case, so even if you look at last year's subsidy allocation, the initial budgeted estimate and the actual spending was much different. So in case, the government feels the fertilizer prices continue to be on a higher side and it requires, better support, I'm sure, those outlays would increase over the period of time. So overall, it's not a worrying situation, and our sense is, things would improve from where we stand today.
George, can you suggest some good ALSS fund?
Right, of course, we have an ELSS fund, which is quantum tax saving fund. And ever since the value style has been doing well, so performance has also been phenomenal. So the last 1 year, if you look at the popular websites, we rank among the top 5 ranks out of almost 34 funds in the category, and that's been true. Even that momentum is continuing even in the recent times. So you can always consider quantum tax saving fund as an option for your ELSS fund. And another important thing is, when you invest in ELSS funds, you're giving that money for a longer term, like you have a 3-year lock-in. So you have to be very much sure in terms of, the track record of that fund house, and even the processes that fund, process in which, that fund operates to generate long-term return. So both of which, we have a very solid process in that sense, and therefore, you can always consider quantum tax saving fund for your ELSS investment.
Thanks, George. Pankaj, next question to you. What's your view on interest rate cycle in India? Are we nearing the peak?
Yeah, so that's the point I placed in my presentation, that interest rate cycles have actually peaked last year and most likely will remain below that level for entire 2023. Means all the evidence are on the positive side. In most of the geographies, we are seeing monetary policy cycle turning. Almost everywhere, bond yields, especially at the longer end, long-term bond yields have peaked in last year and trending down now. So yes, in India also yields have in a way peaked last year and expected to come down.
Yeah, thanks, Pankaj. George, there is I think so. It's a stock-specific question. Within pharma sector, please advise whether API manufacturers are expected to do better than companies dealing with formulation. Would you like to answer that, or?
I'll prefer to skip that question.
Yeah, thanks. Chirag, one question to you. Will the lack of direct measures to boost consumption hurt or delay the recovery?
So it will depend on a lot of factors, actually. If you see, we are good from an economic standpoint today. How much private capex impact it will have, because government is preferred to undertake capex themselves, and last time that translated into consumption as incomes grew and employment grew. And thereafter capacity utilization of companies increased, and thereafter private capex came in. So this time around, again, government has sorted to do a similar cycle of them taking the heavy lifting, and how much time really it will take to transfer that into incomes and employment, and thereafter make private companies more confident to undertake capex is anybody's call, because but we think that private capex, given that it was increasing last year, it will not diminish really so much. It will continue, and thereafter the next leg of the cycle will also start to drive private capex further. So I think it may be a short-term dent. It will not be an immediate trigger to boosting consumption and again bringing in that economic growth very, very swiftly. It may be a slightly slow drawn process rather than an immediate uptick that we may have seen with consumption. So overall, we are not pessimistic in that sense. It may take slightly more while, but it will be more sustainable in nature as compared to handouts or giving that consumption boost overall. Also, one thing that kind of we have seen historically is, governments are not really efficient spenders. Private can do it much more swiftly. So had it been, driven by consumption and then private capex jumping in, it would have been much more efficient investment within the economy, as opposed to one being handled by government, because that would have been driven by more rational decision making rather than into railways, roads, infra, etc., which is also needed to some extent. But I think it would have been more efficient the other way around. But that doesn't make us pessimistic on the economic prospects. We still think that it could still drive the economic momentum. Maybe a lull in between, but again, markets are forward-looking and will price in more medium-term outlook rather than short-term. So any opportunity that you get, if there is any distress in market because of worries on economic growth, I think that should be bought into, given the medium-term prospects still look better overall.
Thanks, Chirag. With this, we'll take the last question for the day. George, it's for you. Can the announced scrappage policy give a boost to replacement demand in auto?
Sure. See, the scrappage policy which was announced was only for the government vehicles, which is a small proportion of the overall demand. And therefore, we may not see a very stark immediate benefit. But from a longer term point of view, the government has kind of directionally given some clarity that they would take incremental measures in terms of promoting that the scrappage of old vehicles and things. So of course, that replacement demand kicker should come at some point of time. But of course, it may not be from the recent announcement where they would promote scrappage of just government vehicles, because that's just a smaller portion of the overall pie.
Thanks, George. With this, we'll end our Q&A session. Chirag, just one last thing. How would you like to summarize the budget, and what would be your advice to our investors?
So I think it was a good budget overall. Could have been better as always, but it was still a good budget overall. Fiscal prudence is one thing that they have stuck to, and with that fiscal prudence and hands tied, you can only do so much. And I think they have done a fair job of it. Maybe slightly disappointed on the consumption, but overall it doesn't matter in the longer scheme of things. So overall, markets are economy is well positioned rather. Markets are not at extremes. There could be volatility in both debt and equity market in the short run, given we are at the cusp probably. And as the medium term prospects of both or all three asset classes, equity, gold, and debt, look promising, I think investors should invest. There will be noise around, there will be volatility. Don't buy into that. Stick to your asset allocation, which is nothing but 12-20-80, which works well in all market scenarios. If you have a long-term approach, you can tweak it the way you want it. You can increase a 12 to 24, 36. You can increase your equity allocation, stagger out your investments over a period of time, but essentially build an asset allocation. Do not chase asset returns. Today, gold is doing well, is at all-time highs, does not mean that you should chase and put all your money in gold, because usually these times are to kind of rebalance your portfolio and move into assets which are not doing well. So have a prudent approach. Budget does not change the trajectory of these investments. I think you should try and allocate to all three asset classes, build a 12-28 portfolio, and I think you should be good for 2023 and beyond. So overall, it's been a good budget. Should make you smile when you make your investments. And please do visit our website for an easy allocation tool that we have built just for you, so that you can make your investments very, very easy, just like the 12-20-80. Thank you.
Thank you, Chirag. Pankaj or George, any closing comment you would like to give?
Yeah, see, from a budget perspective, there could be some short-term implications, or some short-term noise which can happen for a few weeks or months. But of course, investors should have a very long-term horizon, and they should stick to their asset allocation plan and to meet all their long-term goals. And that long-term horizon should not be missed just because of all the news flow which has happened around the budget. Over to you, Pankaj.
Yeah, just a small advice that take risks that you can understand and you can tolerate. So again, from debt fund perspective, I think people should stay away from very high risk, especially going into credit space. And even on the bond fund, I think have a longer holding period if you are kind of investing in any such product.
Thank you for your valuable comments. To know more about our 12-20-80 asset allocation solution, we'll request all our listeners to visit our website, www.quantumamc.com. Also, further, for any questions to be answered, you can write to us at customercare@quantumamc.com, and we'll be happy to answer the same. Once again, thank you all for giving your valuable time. Stay safe and happy investing to you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.